It's often claimed that setting the table is more important to success in your 20s than actually enjoying the meal. I recognize that this sounds somewhat depressing, even though I can understand the reasoning behind it. As someone who will soon enter his late 20s, I've discovered that you can still, as you prepare the table, taste and savor a portion of the feast. Thus, in terms of the financial objectives to accomplish in your 20s, it's about creating and reaping the benefits of sound financial practices while eliminating any undesirable habits. Number 1, establish an emergency savings account. As corny as it may sound, your first financial objective in your 20s should be to develop a reserve for emergencies. Unexpected life occurrences often happen at what may seem to be the worst time, but having an emergency reserve serves as a financial insurance. A well-stocked emergency fund will assist you in avoiding the need to borrow money or carry a balance on a credit card in difficult times, such as during a medical emergency, unexpected auto repairs, or an abrupt layoff. When creating an emergency fund, I advise transferring the funds to a different high-yield savings account to allow them to grow over time, yet remain simply and immediately accessible. Regarding the real dollar amount to set aside, aim for at least 3 to 6 months' worth of living expenses. If you're single, childless, and have a steady salary, 3 months' worth of living expenses ought to be sufficient for most emergencies. However, if you are a parent or have a very variable income, I suggest aiming for about 6 months. While this may seem like a lot, the more money you have saved, the more comfortable you will be in case anything unforeseen happens. Number 2, create and follow a budget. While having money set aside for emergencies is beneficial, a budget helps you plan for all the unforeseen costs that can arise. It helps you anticipate anticipated costs that will arise, hence making budgeting a crucial financial move. A budget assists you in organizing your finances and monitoring the amount of money that enters and leaves your bank account each month. Making a budget may seem like a lot of work, but many tools and applications are available to help. Once you use them, most do all the hard work. You just need to tweak it slightly when your income or expenditure patterns shift. It's critical to adhere to your budget once you have created one. This entails routinely checking in with your financial objectives and ensuring that you don't exceed your monthly spending limit. Additionally, if you share expenses with someone else, make sure you both have access to the budget to ensure mutual accountability. Number 3, eliminate high-interest debt. High-interest debt is like a cloud over your head. Those debts often expand more quickly than you anticipate, like a snowball rolling down a hill. By eliminating them, you save money in your 20s and become more financially independent. While high-interest debt is not strictly defined, I consider anything higher than the average interest rates on student loans and mortgages, typically around 5% as high-interest debt. So, any debt with an interest rate higher than 5% falls into this category. Create a list of all of your high-interest loans and start by eliminating those with the highest interest rates. For example, if you have 3 loans, one with a 15% interest rate on a $2,000 balance, one with 20% on a $3,000 balance, and one with 10% on a $5,000 balance, focus first on the $3,000 loan with a 20% interest rate. Make the minimum payment on each debt except for the one with the highest interest rate. Continue making extra payments on that loan until it's gone. Next, add the amount you were paying on that loan to the payment of the next highest interest rate loan, and so until all the debts are paid off. Number 4, achieve a credit score of 760 plus. Your credit score reveals your creditworthiness to lenders, indicating how likely you are to repay a debt based on your credit history. Your credit score can range from 300 to 850 with a bad, fair, good, very good, and excellent ratings. Aim for a credit score of 760, as once you reach that point, the best lending options and rates will already be available to you. Think of it like getting an A in college, whether your score is 93 or 100. the highest possible GPA is still 4. To establish credit, obtain a credit card is one way to start building credit in your early 20s. By paying off your balance in full and on time each month, you show lenders you are a trustworthy borrower. Once you start building credit, focus on these 5 strategies to improve your score. Maintain timely payments. Use no more than 30% of your credit limit. Keep old credit lines open. Limit the frequency of new credit applications. Diversify your credit mix. Your payment history, which makes up 35% of your FICO score, is the most crucial factor. Establish a track record of on-time payments. A late payment is past due by 30 days, and there is little room for error here. Setting up automatic payments before your due date can help ensure you never miss a payment, but make sure you never spend more than you have to avoid overdraft fees. Number 5, invest in your career. The average person spends around a third of their lives, or 90,000 hours working. Yes, I had the same reaction when I found this out. If that's the case, it's crucial to choose a career in your 20s that you genuinely enjoy and that provides a good salary. After selecting a career path with financial success potential, it's essential to develop your skills, relationships, experiences, and expertise in your 20s to make you a valuable asset in your chosen field. This could involve taking classes or training, seeking out a mentor, networking in your industry, or pursuing higher education. Number 6, start developing multiple revenue streams. Don't rely solely on your 9-to-5 job for income. Your 20s, especially your early 20s, when you likely don't have children to care for, are the perfect time to spend some of your free time on creative projects that will bring in additional income. You can start these side gigs by assessing your interests or skills and figuring out how to monetize them. For example, if you love photography, there are many small opportunities, like graduation or wedding photos, that could earn you several hundred or even thousands of dollars per month. Platforms like Upwork and Fiverr also offer simple ways to start freelancing in various fields. Number 7, invest for the long term. Investing is like planting seeds that grow over time. Your 20s are the perfect time to start investing, as your money has more time to grow and compound. You don't need a lot of money to start. With fractional shares, no commissions, and low or no minimum investment requirements, even small amounts can be invested in index funds, mutual funds, and exchange-traded funds, ETFs. Regular modest investments can significantly impact over time, thanks to the magic of the compound interest, where your returns generate returns. Let's illustrate how compound interest works over time by comparing 2 people, one who starts investing at age 20 and another at age 30. If both invest $100 monthly with a 7% annual return, the average return of the S&P 500 by age 60, the one who started at 20 will have invested a total of $54,000, which could grow to $379,259. The person who started at 30 would have invested $42,000, growing to only $180,105. By starting 10 years earlier, the first investor's account grew more than $325,000, but the second investor only gained about $138,000. In your 20s, setting the stage for long-term financial stability and success is crucial. By focusing on building an emergency fund, sticking to a budget, eliminating high-interest debt, improving your credit score, investing in your career, diversifying income streams, and investing for the future, you can lay a strong foundation that will serve you for years to come. Remember, the steps you take now will significantly impact your financial well-being. So start early and stay committed to these financial goals. Thank you for watching, and I'll see you in the next video.